Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're embarking on part 2 of our options education beginner options series. This is designed to give everyone a cohesive learning experience so that not only do we teach the strategies and theory, but more importantly, we take time to pause and use real examples so that you have a better understanding of the concepts that we're teaching. So today's going to be part 2 of our beginner options series where we talk about the difference between buying versus selling options. This, from my perspective, for anyone who's trading, whether you're brand new to options trading or if you're an experienced options trader, is, in my opinion, one of the most important topics to understand fully before you move on to more advanced strategies and learn other strategies to trade in your portfolio. Without a good understanding of the fundamental building blocks, which are buying versus selling options, it's really difficult to learn and understand more complex strategies. And even within the simple strategies, many times investors ask me, why would I buy a call versus sell a put? So this is today, what we're going to do is make sure that you fully understand when you want to buy a call, when you want to sell a put, when you want to buy a put, and when do you want to sell a call. What are the advantages? What are the disadvantages of each strategy? Because as you learn this, that's where you're going to take this knowledge to the next step. Because as you start to explore complex strategies like spreads, vertical spreads, calendars, diagonals, they're all meant to help address some of the advantages and disadvantages to each one of these strategies, or more importantly, address the disadvantages of each strategy and how to overcome some of those disadvantages. So today, what we're going to do is we're going to break down these 4 strategies so that you get a clear understanding as to what the pros and cons of each strategy is, so that you can take your learning experience to the next level. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So, excuse me, for those of you that are brand new to OptionsPlay, the tool that I'll be using today to provide you with more examples or real examples as to how to apply what we've learned is where I'm going to use the OptionsPlay software. OptionsPlay is available free of charge to all Nordic investors at optionsplay.se. So you can register for a free account using that trading account. Once you register, you have access to free weekly options education, just like the one you are on right now. You'll have access to our options education page. All of the previously recorded sessions are going to be available on that options education page, as well as weekly cover call and short put reports that we send out to our customers. So if you're looking to generate income, if you're looking for education, if you're looking for a platform to help you analyze these types of strategies, that's all available to you when you register for free at optionsplay.se. So today what we're going to cover are a few different things. We're going to first talk about stocks versus options. And the reason I want to talk about stocks versus options is because I want to talk about what are the advantages and disadvantages of trading options. I'm sorry, to trading stocks, because that's going to help you understand what are some of the advantages to trading options. Then we'll talk about the 4 basic strategies, and we'll break them up. We'll talk about bullish strategies first. So buying calls versus selling puts, which are both bullish strategies, but they're actually quite different from each other. So it's really important that you understand when to use which one. Buying puts versus selling calls are 2 bearish strategies. We'll talk a little bit about that. But once you understand the first 2, the second 2 become much easier to understand because they're effectively mirror images of each other. And lastly, we'll talk a little bit about the option Greeks so that you have a better understanding as to how your strategies will actually perform if you buy a call option and the stock goes higher, and then if you buy a call option and the stock goes lower. How do you know how much money you can potentially make or lose from an option strategy? That's what the option Greeks will allow you to have some visibility into it. At the end, we'll go through any questions that you guys might have. So the primary goal of this webinar is for you to leave today with a clear understanding as to what the fundamental difference between buying versus selling options are. Now, how many of you are brand new to options trading? Please type 1 into the chat window if you're brand new to options trading. And please type 2 if you have traded options for a period of time before. I just want to get a clear sense for the audience here in the room. Okay, so I see quite a few ones, but also quite a few twos. So pretty split here between ones and twos. Okay, so like I said, even though this topic typically falls under the beginner category, I tend to find that most experienced traders actually learn quite a bit from this type of strategy, from this webinar, because when you start talking about spreads, when you talk about debit and credit spreads, it's based on these fundamentals that help you decide whether you want to buy a debit spread or sell a credit spread. So even if you're an experienced trader, I think you'll be able to walk away with some new knowledge of options trading. If you're brand new, these are the building blocks. Make sure that you spend the time to learn these building blocks, because it's going to make your options experience and education down the line much easier to understand. So my name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. I've been a market strategist for about 15 years, starting in the currency markets, futures markets, options. And I had the opportunity to start this company about 8 years ago to build this platform and teach users how to trade options. So today what I'm going to be doing is sharing with you my thoughts and my views as to how you should think about options that will make the experience of learning how to trade options and hopefully help your experience with more advanced strategies in the future a lot easier to understand. So in order to do that, we start off with stock trading. Now, before I jump into this, how many of you currently trade stocks? Please type S into the chat window if you currently trade stocks in your portfolio. Okay, so I see a lot of yeses, a lot of S's. And so the reason I bring this up is because most of us are familiar with stock trading. And when we refer to stock trading is what I call pure bullish and pure bearish exposure. What does that mean? Pure bullish and bearish exposure means that you have immediate gains if you get the direction correct. Meaning, if you buy a stock and the stock goes up by even a single crown, you start to make money on that trade. If the stock goes down by 1 crown, you start to lose money on that trade. And the amount of money that you make or lose is completely symmetrical to the amount of exposure that you have. So if the stock goes up by 10 crowns, you make 10 crowns. If it goes down by 10 crowns, you lose 10 crowns. It's very easy to calculate your potential risk and reward based on where you think the stock is going to go. You have immediate gains and you have symmetrical exposure. This is what every stock investor is familiar with. Now, when you trade a stock, it doesn't matter whether it takes a few minutes for the stock to move 10 crowns, if it takes a week for the stock to make 10 crowns, or if the stock takes a year to move 10 crowns. If the stock moves 10 crowns, you make 10 crowns. Doesn't matter how much time it takes for it to get there. The only limitation with trading stocks is that there are no neutral options. So if you think that a month from today, this stock will be back at the price that it started at, you will not make any money if you buy or short sell that stock. There are no neutral options when you're trading the stock. So this is, again, like I said, something that I think most investors are familiar with. When it comes to trading options, instead of having 2 options where you can either where you can buy the stock or short sell the stock, when you're trading options, you have 4 options. And sometimes these 4 options, especially for beginners, it's a little confusing. So we always teach the fact that you can either buy a call, buy a put option, you can sell a call, or sell a put option. So when we talk about buying a call and buying a put, each one of these is effectively an option contract. This is what we covered in our last education event. So I'm not going to go back and review that. So if you missed that, I will show you at the end how to get access to that recording. But when you're buying a call option, this is what we typically call a bullish strategy. And when you buy a put option, this is what we call a bearish strategy. Now, when you sell a call and sell a put, you're basically doing the opposite. So selling a call option is bearish, selling a put option is bullish. So today what we're going to do is we're going to explore these 4 strategies, break them down so that you understand them as to when you want to use each one, what are the advantages and what are the disadvantages to each strategy. So let's go ahead and get started with buying calls, or the bullish strategies first. So the first bullish strategy that most options investors learn is buying a call option. So let's take this example where I have a stock that's currently trading at 100 crowns, and I think the stock is going to go higher sometime in the future. So what can you do? As a stock investor, you would buy the stock. As an options investor, what you can do is you can buy a call option. Now, we say that call options are bullish, but from my perspective, just saying that call options are bullish is not correct. It's actually bullish by a certain amount, and we're going to show you what I mean by that. So let's say I have a stock trading at 100 crowns. I think the stock is going to go higher. So what do? I buy a $100 call option, and let's say I pay 4 crowns for that call option. So what are the advantages, and what does it look like to buy a call option? So when you buy a call option, what you get is unlimited reward to the upside. So if you buy a call option and the stock goes higher, the more the stock goes higher, the more money you can make. So you have unlimited upside unlimited upside if the direction that you call on the stock is correct, and the stock keeps going higher and higher and higher, you make more and more money. Similar to buying a stock. When you buy a stock, the higher the stock goes, the more money you make, and there's no limit as to how much money you can make. Now, when you buy a stock, if the stock goes lower, there is a limit as far as how much money you can lose, but that goes all the way down to 0. So if you pay 100 crowns for that stock and the stock goes down to 0, you would lose 100 crowns. Now, when you buy a call option, what you pay for that call option is the most that you can lose. So in this particular case, on this 100 crown stock, I can have unlimited upside if I'm right. But if I'm wrong, if let's say instead of the stock going higher, it ends up going lower, how much do I risk? I'm only risking 4 crowns. So what you have here is what we call an asymmetrical risk. So when you're buying a stock, that's symmetrical risk. When you're trading options, you have asymmetrical risk. And this is the risk profile that many investors are seeking when they're looking at options, is they want to be leveraged on their capital if they're correct, because you're controlling a 100 crown stock for just 4 crowns. That's an implied leverage of about 25 to 1. And so you have this huge amount of leverage, which, we all know leverage can work in our favor or really blow up our accounts. So here you have leverage when you're right, because they have unlimited upside, and then you have limited downside, so that you, even with all this leverage, if the stock doesn't go in the direction that you expect it to, you're only risking, in this particular case, 4% of the underlying stock price to trade options. And this is the trade-off that many investors are seeking, right? Does this make sense, everyone? Please type 3 into the chat window if the risk to reward ratio or the risk profile of a call option makes sense to you. Okay, great. So if you ask yourself then, if this is so great, if I can have unlimited upside with leverage if I'm right, and limited downside if I'm wrong, why wouldn't everyone trade options? Why would I ever want to trade a stock where I can lose 100 crowns and have the same unlimited upside? The difficulty with buying a call option is the fact that what you pay for that call option is factored into what we call the break-even price. The break-even price is the price at which this strategy will break even, which means that you have to not only believe the stock is going to go higher, you have to believe that the stock will be exceeding the break-even price. The break-even price is calculated based on the strike price plus the premium that you pay for the call option. So if you pay 4 crowns for a 100 crowns call option, your break-even price is at 104. So not only do I have to believe that this stock is going to go higher, I have to believe that the stock is going to go to at least 104 or higher if I get the direction correct. But let's say the stock only moves up to, let's say, 102. Guess what? I got the direction correct, but because I didn't exceed my break-even price, I actually lose money on this trade. So what you quickly learn about trading call option is that it's not just bullish, it's what I call bullish by a certain amount. And that certain amount is governed by how much you pay for that call option. Sometimes these call options are cheap when volatility is relatively low. Maybe this is 3 crowns or 2 crowns, but when volatility is really high, it might be 5 or 6 crowns. So you can't just say, I think the stock is bullish, let me buy a call option. You have to say, I think the stock is bullish, how much does the call option cost? What's the break-even price? And do I think the stock is going to exceed that break-even price or higher in order for it to make sense for me to buy that call option? And that's a big, big distinction. I hope everyone understands that. Please type 4 into the chat window if that makes sense to you. Because what's possible is that I buy a call option on this stock, and let's say the stock goes up to 104. So I got the direction correct, but I didn't make any money on this trade because I've just gotten to the break-even price. So you have to factor into what is the break-even price of my call option? Do I think the stock is going to exceed that level? And if I do, that is the only time it makes sense to buy a call option. And that is probably the hardest thing to learn at first when you're trading options, because you're not used to that when you're trading stocks. When you're trading stocks, you're just thinking, I think the stock's going to go higher, let me buy the stock. Here, you have to say, how much does a call option cost? And do I think that stock is going to exceed that level or not? Okay? So what you quickly find out when you're buying a call option is that if the stock's currently trading at $100, if you're wrong, right, you will lose money on that trade. If the stock doesn't move, meaning if it stays at $100, you're not right, you're not wrong, guess what? You also lose the 4 crowns that you pay. If the stock moves a little bit in your favor, you can still actually lose money on the trade. Only in the scenario where if the stock makes a big move to the upside, do you make money. So as you can see in multiple scenarios here, if the stock goes against you, if the stock stays the same, if the stock moves only a little bit in the direction that you expect it to, in all 3 of those scenarios, you lose money on this trade. Only if the stock makes a big move, do you make money on that trade. And that's the trade-off that you're making for this asymmetrical risk. So before I said, you know, this asymmetrical risk sounds great, right? Who doesn't want to have limited risk with unlimited upside? That does sound great. But the challenge here is that in most scenarios, you'll actually lose money on this trade. And that is probably, in my opinion, the most important thing that options investors who start out need to learn. Because buying options is a tough scenario to make money from, because you really need the stock to make a big move before the strategy is profitable. So which is why when you're buying call options, what you're generally seeking are call options that are extremely cheap. What you want to find are call options that maybe are trading at only 2-3% of the underlying stock price, so that the stock doesn't have to move as far before you're profitable. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, so now let's talk about the other bullish strategy, which is selling a put option. So on the surface, when you look at selling a put option, it doesn't look particularly attractive. So I'm going to use the same example, stock XYZ trading at 100 crowns. And this is a stock that I think is going to go higher in the future. So what you're going to learn is that selling a put option is also an alternative bullish strategy. But from my perspective, it's not accurate to say that it's a bullish strategy. It's a somewhat bullish strategy, but not by too much. And I'll show you as to what I mean by that. So let's say I think the stock's going to go higher. So what you learn is that you can sell a 100 strike put option. Before we bought a 100 strike call option. Here we're selling a 100 strike put option. And let's say in this particular case, because you're selling the option, you're the one collecting the premium. Before, when you're a buyer, you're the one paying the premium. Here as a seller, you collect that premium. So the risk profile of a put option looks like this. If the stock goes in the direction that I expect it to, I keep the 4 crowns that I collected on selling this put option. If the stock stays at 100 crowns above the strike price that I sold the put option for, I keep also the 4 crowns. If the stock goes against me, well, actually, let me make this a little simpler. When you sell a put option, as long as the stock stays above the strike price that you sold it for, so I sold the 100 strike put, as long as the stock stays above that price, I keep the 4 crowns that I sold. To the downside, if I get the direction wrong, what happens is as I start to lose more and more money, and technically there is a limit as far as how much money I can lose, but that's when the stock hits 0. That's the maximum that I can lose. So many investors, when they first look at options, they will say to themselves, well, why would I ever want to take on the risk profile where I have limited gains? Here, the most money I can ever make is just 4 crowns. It's a $100 stock, a 100 crown stock, but I can only make 4 crowns. And if I get the direction wrong, what happens? I can lose more and more and more money. And if the stock goes all the way 0, I'm risking, in this particular case, 96 crowns in exchange for just 4 crowns of potential reward. And many investors, when they first look at this, they'll say, That sounds terrible. Many investors, especially beginners, will say, I'd much rather have a risk reward ratio that looks like this, where my max risk is 4 crowns and my max reward is unlimited. But when I look at a risk profile that looks like this, where I'm risking 96 just to make 4, that doesn't sound very good. But when you look at this again, what you realize is that this is a very forgiving strategy. Meaning, if I get the direction right, I make the 4 crowns. If I get the direction incorrect in the sense that the stock doesn't move higher, I still make 4 crowns. If I get the direction completely wrong and the stock moves lower, I can still make money because guess what? I have that 4 crown buffer. So even if the stock goes below 100 crowns, which is the level that I was expecting the stock to stay above, even if it goes below that level, I have a bit of a buffer because someone paid me 4 crowns to sell this put option. So if the stock goes down to 96, I break even. If the stock goes down to 90, that's when I start to lose money. But as you can see, in most of the scenarios, before when I'm buying a call option, most of the scenarios I lose money. When you're selling an option, it's the exact opposite. In most of the scenarios, you make money. And only if the trade goes really far against you, do you lose potentially a large amount of capital. Does that make sense? So please type 6 into the chat window if that makes sense to you. Because this is the trade-off that you're making with all option strategies. Either you're buying an option strategy and you need the stock to move a huge amount before you make money, or you're selling an option where you have the ability to make money in most scenarios unless the stock makes a big move against the direction that you expect it to. So whenever you're trading options, those are your 2 choices. When it comes to I have a bullish or bearish view on the markets, you have the choice. Do I want to be buying options and I need the stock to make a big move, or do I want to be selling options and make money in pretty much all scenarios unless the stock makes a big move? And what you start to learn as you do more of these trades and start to look at some more strategies is that you will start to see that selling options has a bit of an edge because it really provides you with profits in a lot of different scenarios. And I think the best way to learn that is to use a real example here. So I'm going to use H&M here for an example. And I think this is a good way to learn option strategies. So H&M recently, broke out above 153, some support levels. It's starting to potentially go higher here. So I think this is a candidate for potentially buying some options or selling some puts. So what I'm going to compare using the OptionsPlay tool, which allows you to compare any 3 strategies side by side, is I'll let you compare buying the stock to buying a call option to selling a put option. So buying 100 shares of the stock would cost me 15,000 crowns. Buying a call option would only cost me 870 crowns, and we can use the midpoint here, 820 crowns. If I sold the put option, I would sell it for about 760 crowns. So this is a good concrete example of what we just showed you here. And what I'm going to use is our P&L simulator to simulate exactly how these strategies perform and give you a better understanding as to when you might want to buy that call option, when you might want to sell that put option. So when you click on the OptionsPlay score, what we have here is the break-even price. The break-even price tells you at what point do these strategies break even. So H&M's trading at 154. The break-even price on this call option is 163. So 163 is basically this recent high up here is the 163 level. So you have to ask yourself by November 20th, which is 51 days away, that's plenty of time. Do I think H&M will be above 163 or higher by that date? If the answer is yes, then you might consider buying that call option. But keep in mind, 163 is just the break-even price. You're not profitable at 163. You're only profitable above 163. So what you can use is you can use the P&L simulator and you can actually see just exactly how far does the stock need to go before one strategy starts to outperform the other. Because remember, when I sell a put option, I keep what I collect as long as the stock stays above my strike price. So 155 is my strike price. As long as the stock is above 155 at expiration, I'm going to be able to keep the full premium of the strategy. But my break-even price is actually 147. As long as H&M stays above 147, I will be profitable on this trade. 147 is right here. So you happen to have this, this is completely by coincidence, but you happen to have break-even prices that line up very well with this recent trading range, right? So if I sold the put, as long as the stock stays above this recent low, I'll be profitable. On the buying the call option, I have to have the stock exceed this recent trading range in order to be profitable. So this is what you can use to help you decide which strategy is best suited for you. So if I'm looking at this here, as long as I stay above 147.40, I'll be profitable. Here, I need to be above 163.20 to be profitable. So what you start to see here is that even if I think the stock's going to go to, let's say, 164, here I'm only making an 80 crown profit, but here I'm making a 760 crown profit. So what you realize is that you have to really exceed that break-even price by a fair amount before the call option really starts to outperform selling that put option. So at 170 is the actual break-even price between these two strategies. So at 170, almost 171, that is the point at which the call option starts to outperform selling that put option. So this negative risk-reward ratio on the surface many times looks very unattractive, but what you start to realize is that you really need a big move. 171 is up here. 171 is all the way up here. So I have to believe H&M will be above that level, in my opinion, to really make for it to make sense for me to buy that call option. Now, that's not as easy of a task as saying it'll be above 162. Above 162, you'll break even, but above 171 is when the call option starts to outperform the short put. Does that make sense? Please type 7 into the chat window if that makes sense to you. It's not just the break-even price that's important, but it's really looking at what are the different strategies that you have in your toolbox, which one is best suited based on the outlook that you have. So if you are very, very bullish and you think H&M will be at 180, 190 by November, you should buy the call option, because at 180 or 190, here you'll make 1,600 crowns on your investment versus when you sold the put, you're capped. The most you can make is what you collect, which is that 760 crowns. But you can use the P&L simulator to simulate different prices so that you can actually see at what point does the call option start to break even. So at 170, 171 almost. And you can ask yourself, do I think H&M will be above 171 at expiration? If the answer is no, you should probably look at perhaps selling the put option versus buying that call option. Now, let's also take a look at the downside, right? So we know that this strategy, notice how if the stock stays at 155, I will lose the 700, roughly the 800 crowns that I pay for that call option. So I basically lose everything for what I paid if the stock stays around that 155 level. Well, if I sold the put option, guess what? I still make 760 crowns. So if I get the direction kind of incorrect, maybe the stock goes higher for a little bit and then comes back down. When I sold the put option, I can make a profit from that. When I buy a call option, I lose everything. And that is a difficult pill to swallow sometimes for many investors, because you didn't really get the direction wrong, but you still lost 100% of what you paid for that call option. That's a difficult lesson to learn. And if the stock starts to go against me, so now here, as you can see, the put option starts to eat into that buffer that I have, right? So I collected 7.6 crowns here on a 155 strike. So as the stock goes lower and lower, that starts to eat into that buffer. But even if I get the direction wrong, even if H&M goes down to 148, that's back down to this level here towards the lows. Guess what? I'm still making a profit. I'm certainly not making a big profit, certainly probably not the trade that I want, but I'm not losing money because I have that additional buffer of that 760 crowns. And then what you realize is that the break-even price, 147.40, that's just my break even. So that doesn't mean that I'm losing any money. It just means that I'm not making any money. So at 147.40, that's all the way down here. I'm just not making any money, but here, when I bought the call option, I'm still losing my 820 crowns. So what you realize is that the stock really needs to move a significant amount below my break-even price before the short put as you can see, the stock has to get down to 139 crowns. 139 crowns is down here. 139 crowns is all the way down here, which is the gap, but which is the price before that recent gap higher. So the stock would have to be below this level when the short put starts to lose more money than the long call that I purchased. So as you can see at 139, that's where I start to lose roughly the same amount of money. Only below 139 does the short put start to lose more money than the long call. Does that make sense to everyone? So what you start to realize is that even though the break-even prices are here for the short put and the break-even price is here on the long call, the actual difference between the two strategies is actually more extreme than that. So even though this is technically the break-even for the two strategies, you either have to believe the stock is going to be exceeding that upper level, which is when the long call starts to outperform the short put to basically buy a call option. Otherwise, if you think that the stock is going to be somewhere here, it's better to sell the put. If you think it's going to be here, it's better to sell the put. If you think it's here, to better sell the put. And only here are you better off buying that call option. So what you start to realize is that if you think the stock is going to trade somewhere in this range, you're better off selling that put. Only if you think the stock is going to potentially be out here does it make sense to buy that call option. Does that make sense to everyone? Please type 8 into the chat window if that makes sense to you. This is, in my opinion, the most important lesson that you need to learn when you first start to learn how to trade options. And even for those of you that are experienced in options trading, this might be a new way to look at, what is the right strategy for you to trade. And this is something that we spend a lot of time making sure that investors have a better understanding of these types of strategies so that you have a better understanding as to what is the right strategy for the outlook that you have on each stock. So with that, what I'm going to do is I'm going to jump back to the slides. And what I'm going to talk about are bearish strategies, but bearish strategies are exactly the same as what I just explained to you, but just a mirror image of that. So here I have stock XYZ that I think is going to decline in value. So what I can do is I can buy a put option, and let's say I pay4 crowns for that put option. That means my break-even price on the put option is 96 crowns. So I have the same risk to reward ratio, the same risk profile as a long call as I do for a long put. But now I just make money if the stock moves lower, and I can make more and more money as long as the stock goes all the way down to 0, and my max loss is simply capped at what I pay for that put option. So if I pay for that put, no matter what happens, that's the most amount of capital that I can lose. And just like the call option before, this asymmetrical risk profile is very attractive for many investors, but the trade-off that you're making with this attractive risk to reward ratio is that if you get the direction wrong, you will lose the 4 crowns. If the direction doesn't go in the direction that you expect it to, but it doesn't move in the direction again, so you also lose 4 crowns. If the trade goes in your favor, but not far enough, you still lose money. Only if the stock makes a big move to the downside do you become profitable in this trade. So it's a challenging trade because the more expensive the put option is, the more the stock needs to move before the strategy is profitable. So this is the one thing that I think most beginners don't factor into, is they learn that put options are bearish. So the next time they find a stock that they're bearish on, they just go out there and buy a put option. They don't really look at how much that put option costs. They don't really look at the break-even price. And many times what will happen is the stock will move lower. It'll move in the direction they expect it to. It just didn't move as far as the break-even price. So what they do is they get the direction right, but still lose money on the trade. And if any of you have experienced that, please type 1 into the chat window if you've experienced that, where you either bought a call or bought a put, and the stock went in the direction that you expected to, but you still lost money on that trade. So, and I know every single options investor, when they first start out, have probably had some trade like this, where the trade went in the direction that you expected to, but you still lost money on that trade. And it comes down to this trade-off that you're making, because that's what you're doing. You're trading off an asymmetrical risk profile in exchange for the stock, requiring the stock to move a big move before you make any capital. And then when you sell a call option, you have the exact opposite risk profile. And again, many investors, especially beginners, what they do is they look at this type of risk profile and they say, I do not want to risk 4 crowns. I'm sorry, I do not want to make potentially just 4 crowns with unlimited risk. That does not sound like a good idea. And I'm not necessarily saying that that's a good idea either, because what you're going to learn in future webinars is how do we make sure that you can take on this type of risk profile, but do so in a way with limited risk. You don't have to take on this unlimited risk. And this is really where you can start getting creative with options. But in order to get creative with options and learn how to get creative with options, you must first learn these fundamental building blocks. So when you sell a call option, this is what I call somewhat bearish, but not by too much. What do I mean by that? So when you sell a call option, very similar to selling that put option, just that it's a mirror image. So if I sell a 100 crown call option, and let's say I collect 4 crowns for that call option, as long as the stock stays below my strike price, I'm going to be able to keep the 4 crowns that I sold the call option for. If the stock stays exactly at 100 crowns, I keep the 4 crowns. If the stock starts to go lower, if the stock starts to go higher, if it goes higher by a little bit, I can still be profitable. Only if the stock makes a big move to the upside do I start to lose money on that put, on the short call. So just like the short put, it's a very forgiving strategy that is profitable in many different scenarios. And this is the trade-off that you're making for this, what we would consider a relatively poor risk-reward ratio, is that you're profitable in a lot of different scenarios, okay? So that is all I have to, that I have to teach for today. I think this is, in my opinion, one of the most important lessons to learn for investors of options, is to really understand what you're doing when you're buying versus selling options. What are the benefits? What are the disadvantages? Because what we're going to learn in the next course, what we're going to learn is that how can you reduce this break-even price? How can you reduce what you pay for this call option? Instead of paying 4 crowns, how do you pay instead 3 crowns and lower your break-even price so that the stock doesn't need to move as far before you're profitable? And that requires for us to get a little creative and trade some of these complex spreads. And then what we'll talk about is how do you sell strategies like this, but not do it with unlimited risk and have limited risk to the downside. So if the stock does make a big move, that you don't have to take on this unlimited exposure. This all comes down to how you can get a little creative with options. But in order to do that, in order to get to that point, we must first learn the fundamental building blocks. And that's what today was all about. I hope that this was helpful in giving you a better understanding of the fundamentals of buying versus selling options, what each strategy means, what are the advantages, what are the disadvantages to each one, because that's going to help you find strategies to trade. So with that, what I'll do is I'll do one more example, and let's just use, let's see. Let's find a weaker stock that maybe is moving lower. Let's look at Nokia. Nokia is a pretty bearish stock, right? So I think most people would agree that this is a fairly bearish stock. Recently had a very big move to the downside. Maybe you think the stock is going to continue moving to the downside. So let's take a look at buying a November put option, and let's look at selling a call option instead. Nokia is trading at about 35, so let's make this the 35 put option. Okay, so buying a $35 put option will cost me 240 crowns. That's the first bearish strategy that we talked about, and the break-even price on that is 32.60. If I sold the call option, or if I sold the $35 call option, my break-even price is 37.60. So in the first strategy, I have to believe that the Nokia will be below 32.60. That's all the way down here. So that's all the way down here. So I have to believe Nokia will be below this level just to break even. I have to believe it's going to go below that level to be profitable. Not an easy task to do. When I sell the call option, my break-even price is 37.60. That's up here. So when I sell the call option, as long as the stock stays above 37.60, stays below 37.60, I'll be profitable. But what, again, just like what we showed you here before, what you notice here is that when you use these types of strategies, let me draw this again, 32.60 and 37.60, 37.60. Okay, so those are the two levels, right? When I sell the call option, I have to be below that level. When I buy the put option, I have to be below this lower level. So what you start to learn, again, is the fact that when you're using these types of strategies, the break-even price is only when the strategy becomes profitable. You have to consider, well, when does the put option start to exceed the short call option? As you can see, that's around 30 crowns. So I have to believe that Nokia will actually be below 30 crowns. Whoops. 30 crowns, which is not even on the chart. 30 crowns is all the way down here. So I have to believe that Nokia is going to go back to the prices that it was at back in April in order for the put option to outperform selling that call option, and vice versa. Even if the trade goes all the way back up to the break-even price, right? That's when I just start to lose money on the call option. But when I buy the put option, I'm already down 240 crowns. So at what point does the short call have 240 crowns in terms of losses? And that actually comes down to about 39.40 crowns. So that's just all the way up here. So Nokia would have to be back above 40, which is that major resistance level that we see when the buying that put option will have less risk than selling that call option. So what you start to learn, again, is that you really need a big move above 40 or below 30, which is about right here. So basically, only if you exceed one of these two levels does it make sense to buy that put option. Because if you get below this lower level, the put option will make more profits. If you get above that level, the put option will have less risk. But in all other scenarios, what you're going to find is that selling the call option anywhere in between 40 and 30, selling that call option will collect a higher amount of profit on this particular trade. And this is for November 20th, right? Which is 51 days away. A lot of things can happen in 51 days, but what you can use is an understanding as to what is the expected range of these strategies. And that's what the trading range simulator of OptionsPlay is designed to do. As you can see, the expected trading range is between 29 and 40, roughly 41. So we expect that 68% of the time, the Nokia will be trading between 29 and 41. So as you can see, that is the expected range of that, which is roughly where you're going to see the call options outperform. And only in a very extreme example do you see put options perform better. And that's part of why when we look at the OptionsPlay score, the short call has a significantly higher OptionsPlay score, because what this is saying, in most scenarios, the short call will be more profitable than buying that put option because of all the things that we just talked about. Okay, so that covers what I wanted to share with you here today. I hope that this was useful in helping you give everyone a better understanding of each option strategy here, and in terms of how you can better understand these types of strategies. So we offer a lot of education. It's all available to you here free of charge if you sign up at optionsplay.se. And what I'll do at this point is I'll open this up for Q&A. If anyone has any questions regarding these strategies, if you have any questions regarding if you have any questions regarding the strategies that we talked about here, about calls and puts, or just questions in general about options trading, feel free to type them into the Q&A window. There's a chat window and there's a Q&A window. Feel free to type them into the, you can type them into the chat window actually if you have some questions. And I do want to share with you the options education page, so that for those of you that are looking to learn more, I just posted a link into the chat window with the options education page that we have hosted for all of the previously recorded webinars. This is the options education page. When you go to education, there are educational courses, there are webinar recordings, there are even recordings in Swedish. So for those of you that are looking for more resources, this is all available to you here on the OptionsPlay education website, which I just posted into the chat window. Okay, let's take a look at some of the questions here. Auntie is asking, do you need to own the underlying stock to sell a put or a call? So technically you do not. Some brokerage firms do require you to own 100 shares of the stock before you can sell a call option, because a call option technically has unlimited risk, right? So when I sell this call, there's no limit as to how much money I can lose, because if Nokia all of a sudden, I don't know, let's say Nokia gets bought out by Qualcomm and the stock shoots up to 100 crowns, right? The further the stock goes, the more money you lose. So many brokerage firms will require you to own the stock to sell a call option, but to sell a put option, you do not need to own the stock, because selling a put option, there is a limit as to how much money you can lose. The stock cannot go below zero. So many times a broker will ask you to put up the cash to buy 100 shares of the stock in order to sell that put option. Sam is asking, what about the platform and OptionsPlay? Why is it just certain stocks that you can choose? Sam, we have all of the Nordic countries here. You have Swedish, Finnish, Norwegian, and Danish equities. So you can only choose the optionable symbols. So because this is an options trading platform, you can only choose symbols that have options traded on them. So we have all the symbols that you can trade options in the Nordics here in available on OptionsPlay. Sam, if you had a specific symbol in mind that you know that are, I mean, did you have a symbol in mind that you were looking for that you couldn't find on OptionsPlay? Simon is saying, where can you access the previous parts of OptionsPlay? Only get the trading window. Simon, what do you mean by you only get the trading window? You meaning you don't have all three panels? NEIL. So is that a optionable stock? So if it's an, oh, sorry, I don't think we carry, yeah, so the Norwegian equities, the Oslo Børs is a separate exchange. It's not a NASDAQ exchange. So on the Norwegian side, you could only trade the OMX 020 index options. We do not carry Norwegian equities, because unfortunately that's traded on a different exchange than the NASDAQ exchange. Simon is saying, at the start of the lecture, I saw where the webinars are now. Thank you. Okay, great. Sam, I hope that answered your question about Norwegian stocks. It's because the Oslo Børs is a separate exchange and we only have access to the NASDAQ exchange. NASDAQ is what's paying for your free access to OptionsPlay. So we only have access to the NASDAQ exchanges. Simon is asking, say, if we buy a call option, if you're right in your prediction, will you have to buy all the underlying stocks or can you do it any other way? Great question. Let's go back to H&M as an example. So let's say you buy a call option and you get the direction correct and the stock makes a big move to the upside. So let's say by November expiration, H&M is trading at 175. 175 crowns. As you can see, the question is, how do you actually get this profit? I believe is Simon's question. How do you actually profit that $1,350? The answer is very simple, Simon. What you do is right now you're paying 1,150 crowns for that call option. As you get closer to expiration or at any point between now and the expiration date, you can always sell the option for a profit. So you're paying 1,100 crowns today, maybe a month later, you're able to sell it for 2,200 crowns and you keep your 1,100 crown profit as a result of that. So you, generally speaking, most investors, I would say 98% of options investors will never hold an option through expiration and will never exercise an option. What they typically do is always simply sell. If you bought an option, you would sell to close. If you sold an option first, you would buy to close. So you always just take the opposite transaction, close out the position before expiration. Rarely does it make sense for you to exercise that call. So it's just like a stock transaction. You buy it for a certain price, you sell it later for a higher price, you make the difference. It's the same thing when you're trading options. You're either buying it at a price and selling it later at a higher price, or if you're selling an option first, so if we're selling a put option like we were talking before, if let's say I sold this November 150 put for 500 crowns, what I would want to do is, or let's say I sold the 155 for 710 crowns, and let's say a month later this put option is only trading at 300 crowns, what I would do is I would buy back the put for 300 crowns, and I would make the difference between the 700 crowns that I sold and the 300 crowns that I had to pay later to buy it back. I would make the 410 crown difference between the two prices. I hope that answered your question, Simon. Sam, how do NASDAQ choose which stocks are optionable or not? So it really comes down to how much trading happens on the underlying stock. So H&M trades for example, today has already traded 5.1 million shares. That's a fair amount of volume. It really just depends on how much the underlying shares trade in terms of volume. It needs to have a certain minimum market cap. It needs to have a certain amount of volume is usually the typical requirements that the exchanges look at before they list options on that name. Yeah, so I know I think there are probably close to 300 names that are listed on the Swedish Stock Exchange, but 64 of them have options. It's because not all of the 300 have enough of a large enough market cap, and they may not have enough trading volume on a daily basis for options market makers to make a market on that. Milka is saying, in terms of timing, are there suggested exit dates in terms of different strategies, such as 30 days before expiration versus buying calls? So yes, there is. I don't have quite enough time to get into all of those today because today was more fundamentals. Today, we didn't really get into real strategies because for most investors, you may not sell a naked call option. I actually don't recommend investors to sell a naked call option. The next course, which we're going to talk about actual strategies that you would deploy in your account, we do talk about what are the rules for how far out do you enter, how far out do you exit those trades. Mika, if you want to learn more, we do have some of those recordings. So if you look at our educational courses, we have this intermediate options course where I talk about optimal expiration dates and strike prices. I also have one on adding yield to your portfolio, adding leverage to your portfolio. Both of these talk about specific strategies, and we talk about what are the best practices for how far in terms of expiration date and strike price should you enter the trade, and what should you look for to exit those trades. So they are strategy dependent. Each strategy will be a little different. So I do suggest that if you have a specific strategy in mind, watch the recording for that, because that's when we do talk about specifics like what you're asking. How can I buy OMX S30 index? Is it the same or different? It is exactly the same. So when you go to the OMX S30, just understand, is a cash settled index, which means that you are trading just the index itself. You can never take delivery of the index because it's not a physical asset. There's no underlying stock. The only thing that you can similarly do is trade futures on it. So if you want to buy a call option on the OMX S30, you can certainly do that. So the symbol for that is simply OMX S30, but you can buy call options, you can sell put options, you can do all of that using this tool. When will these two latest webinars be uploaded? So we usually upload them within no more than one business day. Usually they're uploaded sooner than that. We usually get them up pretty quickly on YouTube. You can follow us on YouTube, or you can keep an eye out on this website, which usually gets updated right after these courses are done. I will look into the September 16th one. Okay, I see what you mean, that the September 16th one is not updated yet. I'll make sure that we get that live on this website. So we'll make sure that we upload this one and this one later today. Any other questions regarding options trading? Sam is saying you can't buy or sell options here in this platform, right? That is correct, Sam, but we are working on that with the brokers. But right now, what you can do is when you click on trade, we have what's called a short code. So for example, if you log into, let's say, your Nordnet account, and I've used this already, you can basically take the short code and you can search for it in your Nordnet account. I actually recorded a video for Nordnet a few weeks ago on this front, where you can copy the short code, search in Nordnet with it, and it will populate the strategy for you. You can do it in Avanza as well. So this short code, you can just search in Avanza or Nordnet, and it'll bring up this specific contract for you to enter. And just make sure that you use the same way to enter this order. So for example, you want to sell this put option, sell to open one contract, the November 20, 1820 put option. The premium currently is trading at 61 by 73 crowns. The midpoint is 67 crowns, and you can use that for your order entry. Do you want to sell the bought call the day before, or is it like 6:30, 6:40, or closes at 7:25? Simon, are you referring to closing an existing position that you have? You know, I generally would tell you that you would want to close out any positions at least 15 minutes before the close. When you get into the last 15 minutes, market makers start to widen out the quotes. The bid-ask spreads start to get wider. The amount of contracts that you can trade at those bid-ask spreads are also going to decrease. So we generally encourage investors, especially if you're approaching expiration. So this is why we usually tell investors, don't wait till expiration before you close out a trade. You should do it a few days in advance, and you should do it generally no later than 15 minutes before the close. Because again, as you get into the close, as a market maker, they don't want to take on a huge amount of risk right before the close if they're not able to offset that risk. So what they do is they widen out the quotes as you get closer to the close. So don't wait till a few minutes before the close. You're going to have a tougher time getting out at the price that you want to get out of your trade. So the contract closes at the market close on the last day. That is correct. The contract closes on the closing price on the last day of expiration. To get the trade ticket on any strategy that you're looking at, there's a trade button under each strategy. When you click on that trade button, that will bring you to this trade ticket, and you can copy the short code, which is right here, to give you the contract that you can search in Avanza and Nordnet. You're very welcome, Sam. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out here this afternoon, or this evening rather. I know that this is a topic that could be a little confusing at first, but I again think that this is one of the most important lessons for investors, regardless of whether you're brand new to options trading or if you're an experienced options trader, to make sure that you really understand these types of option strategies, what the differences are, what the benefits, what the advantages, disadvantages are, because it's really going to be helpful in giving you a better understanding as to what strategy makes sense to you. And notice how extreme the two examples are. It's very crystal clear how far the stock needs to go before buying options make sense, and just how selling options make money in most other cases. It's a pretty clear-cut choice. It's rarely do you find yourself in a position where you're like, not quite sure, should I buy that call option or sell that put option? Usually it's a very clear choice. And that's what I was hoping to illustrate to investors here today, because as you get more advanced in options trading, as you start to look at spreads, you also have that same question, you know, should I buy the option? Should I sell the option? But I hope that, you know, with access to the tools like OptionsPlay, with access to this information, it becomes a much easier decision for you to make. So with that, thank you so much. I hope that you guys have a great evening. I'll send you the recordings once we're finished here, and we'll make sure that we'll update that educational course website with those recordings. Thank you so much and have a great evening.